Good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review for the week of 10th of July. My name is Benjamin Goh, Head of Research and Asset Education here at SIAS, and we have Sunny So, our Senior Technical Analyst. So the disclaimer, as usual, is that SIAS is a registered charity. We are not licensed by NASDAQ. So whatever that we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. Do see a licensed financial professional before taking any kind of action in the capital markets. Couple of announcements before we get to today's content. The next ASEAN session is on July 19, Wednesday. This is the QR code to choke your seats. This is catered to, or rather exclusive to us, to SIAS members. So if you're not a SIAS member, then you might want to consider becoming one. We are using Google to review our shows. So please use the QR code to give us a 5-star rating. I'm being very blatant now. 5-star rating. Yes, thank you. And as I mentioned just now, if you're not a SIAS member, you might want to consider signing up. So this is $1 per month, $12 per year. So that's not a typo. It is $1 per month. Okay, let's get going. So I want to talk about the upcoming, totally imminent second quarter earnings coming out of the US. So I want to talk about the narrative. So the background narrative is that, well, we've got a string of information that came out last week and the week before. And it does look like the Fed is going to be keeping its hawkish outlook in the sense that, inflation is not coming down as fast as possible. Some of the anecdotal evidence that came out was that the non-farm payrolls for June that was released last week, Friday, was up 209K. That's the actual number versus 230K estimated consensus estimate, which is below expectations, which is good in a sense because it gives the impression that the economy is slowing down, and therefore inflation should come down alongside with it sooner or later. So that's good from the perspective. The challenge with the non-farm payrolls was that the expected wage growth was actually stronger than expected. So it was did not come down actually. So which gives the impression that inflation, or rather employment-led inflation or wage-led inflation is still stubbornly high. So hence now there is currently a 2-to-1 odds that the Fed will hike interest rates in July. And possibly the next meeting in September, they might consider doing that, but that's not the base case right now. But again, the base case is that in July meeting, the Fed was probably going to hike interest rate by another 25 basis points, I beg your pardon. Okay, so the US stock market has been, hitting new highs until recently because of the tech-led rally. And I guess what we want to do is to caution that the higher for longer rates, which is very quickly becoming the base case, has not been fully embedded into the valuations right now. We already have seeing profit warnings from a couple of major companies, for example, FedEx, ExxonMobil, as well as Nike, have both given profit warnings as well as below expected outlook for the rest of the year. Okay. Now, Bloomberg does a, what you call a survey quite consistently. So the one that they just did was really about the second quarter earnings, and that's what we're going to focus on today. So the questions are, do you expect, or rather we have seen a series of profit warnings lately. Do you think more profit warnings are coming? Well, you can see that 54% of professional investors, as well as 58% of retail investors think that more profit warnings are going to be coming. And that can really be seen in the second quarter earnings season, which kicks off this week, actually. So do look out for that. Then, of course, that's actually the majority. So the minority would be split between the sentiment that the earnings season will be broadly reassuring. That means kind of like about there. And the last one is earnings reports will deliver predominantly positive surprises. So that's basically quite a bullish case, which is the vast minority. All right, so more than 50% of people think that, or rather they hold more of a pessimistic view. Okay, now the challenge for higher for longer interest rates, again, this is based on a poll, is that 42% of respondents think that the further tightening in financial conditions will be one of the consequences of high interest rates. Basically, what it means is that companies will find it more difficult to get credit, not just companies, but also people like you and me. We already do know that high interest rates are going to put more pressure on margins for weaker companies, especially things like their interest coverage. And we already know that about $500 billion or $500 billion worth of, these are US dollars, worth of triple B rated bonds are at risk of being downgraded if interest rates are going to stay higher for longer. So that's going to be an impending issue. We also do know that the number of bankruptcies in the US, as well as the severity of bankruptcies in terms of liabilities the company had before going bankrupt, is on the upswing. So not as high as during the peak of the COVID pandemic, but still definitely uptrend. So we are, seeing more and more bankruptcies in the US. So this is going to be an ongoing issue as interest rates are going to be higher for longer. 36% of respondents think that there's going to be economic slowdown. Yes. 18% thinks it's going to raise costs as well as high inflation, because the high interest rates are then going to feed into the high cost structures for companies, and then they're going to pass on to consumers. And then you got 5% for other. Okay. So this survey is basically a mixture of both professional as well as retail investors, and really it's more of a downside rather than upside. So there's no scenario where higher for longer interest rates have got a silver lining, except for fighting inflation. Next question in the poll with regards to the second quarter earnings season is: do you think the upcoming earnings season will confirm a deterioration in the outlook and hurt bank stocks? Okay, so the narrative here is that obviously high interest rates, some companies are going to fail, so that's going to add to the default rates, and of course that will pressure the banks. Banks are going to pull back on lending, especially for creditors or other companies or individuals with bad credit, so they can be lending less and therefore earn less money as well. And then possibly you could see a slowdown on the wholesale banking side, the wealth management banking side. Let me see. So 54.7% of professional investors think that bank stocks will be hurt, and 49% of retail investors also think the same way. So as you can see, about 50% or more think that the bank stocks are not going to do well. Now, this is a key event to monitor. So the 14th of July, that means this week in the US, the second quarter earnings will be kicked off with JP Morgan, Citigroup, as well as Wells Fargo reporting. So quite crucial for us to keep an eye on this to see whether or not this big company is a bellwether or standard bearers of the US financial industry are going to beat their earnings or fail miserably. All right, so that's something we look out for. Gives us an indication of what might happen going forward. Now, the base case is still on track. The base case that we as SIAS have been advocating since January is that the earnings, the first half is going to be terrible, second half is going to be better. So again, we still do expect earnings per share to start, to continue coming down, but then by the end of third quarter, that should be the trough, the lowest point of the earnings per share decline, and then we again do think that in fourth Q onwards is where we can expect the rebound. That has got a impact on the tech stocks. So if you guys have been tracking this, the NASDAQ 100 index has been up about 39% in the first half of 2023 this year. Of course, the market leaders will be companies like NVIDIA, Microsoft, AMD, so on and so forth. 70% of respondents think that the impact from AI on tech earnings is overblown. And again, if you look at the consensus target price for NVIDIA, especially for NVIDIA, just focusing on this, is the current stock price is already at or above the target price. And this is taking into account the press releases as well as the new product releases that NVIDIA has announced. So if let's say there's any kind of disappointment in the second quarter earnings for these companies, they are going to be especially vulnerable to a stock price correction, which I think it's overdue. Already you can see in the last few days, and probably Sunny's going to be talking about this, the S&P 500 has been kind of plateauing, all right, not doing much. Again, I guess in response to, or rather in anticipation of the non-farm payrolls, which came out on Friday. And of course, next week we've got a couple of market or rather economic indicators coming out. I think the CPI is coming out next week. Yeah, this coming week, right? So that's something to look out for.
Thanks, Benjamin, for the insightful sharing. So I'll start off with the economic data that happened last week as well as next week, what we are going to see on the US side of things. So last week, we have the non-farm payroll data coming in at 209,000 versus the previous reading of 306,000. So this is a pretty significant drop in the non-farm payroll numbers and also lower than the consensus of 225K, which means that this number is definitely a bad number. But it does not signal that the economy is going in a downhill state. It's just that it may relieve some of the pressure of the Fed with the need to increase the further rate hikes towards the end of the year. Unemployment rate also come in 0.1% lower for the month of June versus the previous month reading of 3.7%. And that's in line with the 3.6% consensus that the market is expecting. So this data here on the headline numbers of the non-farm payroll data and the unemployment rate do suggest that the economy is slowing down, jobs numbers are coming down, unemployment rate is also coming down slightly a bit. However, these headline numbers do not take into account the average hourly earnings, which increased by 0.4% in June and 4.4% from a year ago. So this is still a mixed bag kind of data, but then it's not reflected in the numbers because one of the important measures in the job numbers was the average hourly earnings. So this is a number that the Fed could be looking at, which could also give the Fed a more pressure to increase interest rate further towards the second half of this year. So non-farm payroll is a mixed bag number. So we cannot take into account that the economy is actually doing well or signifies that the Fed is going to pause the rate hike going forward. On this week data, we can see that inflation rate number will be coming out on Wednesday. So this will be one of the key headline numbers to watch for the Fed FOMC meeting on their decision for the next rate hike in July. So the previous reading was 0.1 and market consensus was 0.3. So we expect a bit of an uptick in the inflation rate month-on-month number for the month of June. So a 0.2% increase is expected, adding on to the previous month reading of 0.1. So this is a bad news. If the number comes in line with consensus, it will mean that inflation is likely going to be sticky. Year-on-year number, we expect it to come down to 3.1% from the previous month reading of 4%. And if that is true, we are one step closer to the 2% mandate of the central banks, US central bank, that they want to maintain the inflation rate steady at 2% level. So if we hit that 3.1%, it will be good news for the market. Core inflation numbers for June is expected to come in at 5% versus the previous month reading of 5.3%. So if core inflation were to come down also, it will release some pressure of the Fed with the need to increase the rate further. And then core inflation for the month of June will be looking at 0.3% versus the previous month reading of 0.4%, so expecting a drop of 0.1%. So these are the key data that we'll be observing for this week on the US side of things. On the Chinese side today, we observe the inflation rate data coming out flat at 0%. And this is versus the previous month reading of 0.2%, and also the consensus was also at 0.2%. So inflation is actually slowing slightly, I would say, on the Chinese side of things. So on the North Asia economy, I think that it's cooling down a little bit, but then not a big difference that we have to be worried about. So next, let's look at the CME Fed Watch tool. So this is the comparison of the current Fed funds target rate probability that we will be seeing on the 26th of July, what the Fed meetings will be deciding. So we are now looking at about 92.38% that we are going to see another 25 basis point hike for the 26th July meeting. This is slightly coming down from the 93 to a 5% or 6-7% increase from the previous week reading of about 80+%, 86%. So I would say that the 25 basis point hike that we're expecting towards the end of the month at 26 July is more likely priced in now, because the yesterday reading of the probability as well as the today's above the 90% means that market are already expecting the 25 basis point hike. So if the hike is going to occur, it should not be seen as a surprise, and market should have already factored that in. However, if let's say we have a pause, then definitely it will be better news for the stock market and the major indices as well. So next, I'll be looking at the technical of the global indices. So let's first start with the Dow Jones Index. So this is the Dow Jones Index. Last Friday, it's a drop about 0.55% or 187 points. So you can see that we have seen a sort of a pullback towards the later part of last week. So this pullback is actually a good thing, I would say, because market has been overly extended since the beginning of the year. And this pullback and consolidation could be a good thing to sustain the uptrend that we have been seeing for the past 6 months at least. So this is actually a healthy kind of a pullback, because it has not broken the uptrend line that you see over here, connecting the low of October last year as well as the March of this year. So the uptrend that we see, the longer term uptrend, is still intact right now. The MACD indicator is now a negative, the reading at 31.97. So that means that the pullback has actually triggered the increase in the momentum of the Dow Jones Index. So we have also breached below the zero baseline. So if we will want to watch closely whether this downtrend momentum is a gaining momentum towards the downside, with the lower bound of the Bollinger Band maybe creating some support at 33,470 points, with coinciding with the uptrend line that you see over here in green. The RSI reading is at 46.83, which is just 4 points below the 50-point neutral mark. Also signifies that we are in a pullback right now. However, the momentum is not that severe, and it's very close to the 50-point neutral mark. So this indicator would likely be closely watched, as well as if the trend of the RSI were to breach below the 40-point level, closing in towards the 30-point level, that would mean that index might be oversold and then a rebound might come in pretty soon. So this is the Dow Jones Index. So it's pretty sort of a muted compared to the rest of the other major US indices over here. Next, let's move to the S&P 500, 0.29% last Friday. For the whole week, the S&P 500 actually dropped 1.16%. So the predominant sort of a market chart pattern that you're seeing on the S&P 500 would definitely be the double top formation that you see over here on the high of 16 July, on the high of 16 June on Friday, as well as the high on 30th of June. So the level at 4,448 now becomes a very significant resistance level, as this is a double top formation. The S&P 500 pullback last Friday or last week is also gaining some support from the 20 days moving average, as you can see over here. This is the basis of the Bollinger Band, which is the 20 days moving average, providing some support to the S&P 500. However, the uptrend, the S&P 500 is still very elevated from the longer term uptrend that you can see connecting the low of October as well as in March of this year. So S&P 500 may have a chance of a greater pullback compared to the Dow Jones Index, which is very close to the longer uptrend line. So if the S&P 500 were to pull back, the likely support level, the first one that will come in would likely be the lower bound of the Bollinger Band at 4,270 points, followed by the 4,114 points, which is the double top formation that you see in December last year. The MACD, as you can see, the MACD line and the signal line are both pretty elevated, quite high above the zero baseline. And we also observed last week the first crossing of the MACD line below the signal line, with the first negative MACD histogram appearing on Friday. So that means that we may see a change in the direction of the uptrend of the S&P 500 and have a pullback and a consolidation area towards at least the double top formation that you see in May this year, which is around the 4,195 level or the 4,200, followed by the 4,114, which is the December high. Both of them are double top formation, which may have a change in polarity to become a support level. On the RSI, the latest reading on Friday is still at 58.61. So that is above the 50-point neutral mark. So that means that although the momentum has been coming down, it still has some strength, and hence the pullback of the S&P 500 should not be that severe. And we are looking at if it holds above the longer term uptrend line, as well as the double top formation on the previous two occasions, providing some support, the S&P 500 should still be able to survive the longer term uptrend going forward into the second half of this year. Next, let's look at the NASDAQ Composite Index. So the NASDAQ Composite Index closed last Friday down 0.13% or 18.33 points lower. So we can also see that it's sort of a double top formation similar to what we see in the S&P 500. So this is the level to watch. 13,864 points would be the resistance level. 20 days moving average as usual, providing the same support to the NASDAQ Composite similar to the S&P 500. However, the immediate support that the NASDAQ Composite Index is looking out for will be the 13,181 points level. Now, this level over here is actually the high that we saw in August last year. So this will be the first support level for the NASDAQ Composite Index should a pullback happen. And this coincides with the lower bound of the Bollinger Band at 13,178. So with these 2 points, finding confluence, it will provide a strong support for the NASDAQ Composite Index if a pullback were to happen. The MACD indicator, as you can see, has already been trending downwards since the beginning of the month, I would say, or even the last week of June. The MACD line actually crossed below the signal line somewhere around the 23rd June, the Friday on the third week of June. So this would mean that we have already seen some pullback happening, or the sort of negative momentum starting to set in since the last week of June into the NASDAQ Composite Index. This also explains why the MACD histogram is in the negative territory, and the downward momentum might actually accelerate if the MACD line were to diverge away from the signal line into a downward direction. The RSI is still pretty healthy with a reading of 60. Of course, it came down from the high during the 15 July period where it hits the 78-point mark, which means that the NASDAQ Composite Index during that point of time in the middle of June was actually in the overbought territory. So NASDAQ Composite now, what the indicator is telling us is that we might see a slight pullback and hopefully a consolidation around this area, that it do not break down further, and hence on the second half of this year, it can continue to stay on its uptrend with the stellar performance in the first half of this year. So RSI at a reading of 60 is 10 points above the 50-point neutral mark, meaning that if you can have some kind of a positive momentum in the NASDAQ Composite Index right now, which will provide some kind of buffer towards the pullback that we are seeing right now. Okay, so next I'll move to the STI index. So the STI index has been on a downtrend since the high that we see on 16th of June, which is around the level of about 3,227 points. So this is the high that we see recently in the middle of June, and we have seen have a pullback. So where's the STI heading? According to the MACD indicator, we can see that the downside momentum is actually expanding downwards. MACD histogram is also getting more negative each day, each of the trading day. MACD line is diverging away from the signal line. That means that the downwards momentum is actually expanding. The RSI has also seen that we are going towards the 30-point, which is the oversold signal territory. The last Friday reading was 30.97 and the current reading is 35.56. So we have not actually breached the oversold level of 30 point yet. So that means that it's still not a perfect time or a right time or a more than correct time to get into the STI index for a rebound to happen or a reversal upwards to happen. So I would say that the STI index might have some negative pressure and may even retest the 3,127 points level, or even a 3,094 points level, which is the year-to-date low that you see in March this year. So this is still the target with the bearish sentiments as indicated by the indicator. So STI index might retest the year-to-date low at 3,094 points or the 3,100 point handle, and that would be a better support level for the STI to do a rebound upwards towards the second half of this year. So that is my take on the indices this week. Anything else to bet, Benjamin?
No, thank you very much for that. So very interesting to see where the markets are heading, and obviously this week is going to be perhaps a bit of a volatile week. Okay, so do look out for events that's coming out this week, especially the start of the earnings report as well as the CPI numbers. All right, so thank you very much for joining us today. So have a great week ahead.